All right. Good morning, everybody. As we generally do, is start with Market Watch, jobless claims. We got a pretty decent list of things on the schedule today. 8:30, 10, 10:30, 11, 11:30, 1 o'clock. The balance sheet for the Fed will come out at a point that it really doesn't matter to us. It'll matter more tomorrow, but tomorrow's got its own issues. All right, we got that CPI tomorrow. We do have this wait and see attitude in the market right now. So, they've been waiting for these job numbers, but they are also really waiting for those CPI numbers tomorrow. And then next week we do have big numbers coming out that we will be dealing with. So there's a lot on the table, a lot on the agenda, so that when we're looking at a market like this, there's an expectation that we're going to continue to have that wait and see attitude. As I've said before, and I'll continue to say it, if you find it difficult to trade, try not trading in a ranged marketplace, right? Yesterday was a perfect example of this. If we're inside of the Globex, you're very likely to have a ranged, choppy day. And if we're inside of yesterday's price action, you're likely to have a ranged, choppy day. But the first thing on the list would be, are we still inside this box? And if the answer is yes, then through your entire trading day, you may find it more choppy than you want to deal with. I'm not saying you shouldn't trade it. I'm saying if you are losing more than you win, quit doing the hard stuff and go do the easy stuff. We've got a new muted range today. Same situation. A whole lot of nothing at this point, and it is likely to continue for the same reason. We're on this wait and see from the market. We need those numbers to come out. They don't want to commit, and so we see it reflected in the chart. We're very likely to have the same kind of muted day, although one of the things they've been waiting for are these job numbers, and those are coming in today. The CPI is tomorrow, but tomorrow's another day, right? So just be on watch. The additional auction today, if I remember right, it's the 30-year. Go back and take a peek. Yeah, it's the 30-year. Stay on your toes and be nimble at around 1 o'clock. You may need that superpower. The 30-year auction can galvanize our market and get us out of this range. Irrespective of anything else going on out there with the wait for CPI, this could do it right there, right? So around 1 o'clock, just be very careful. So a break to the upside. Should we manage to make it back through, we will deal with the Globex high. We'll deal with the high of yesterday. And at that point, we would need to just use our Fibonacci tools for each leg higher and each target up, the way that we normally do in a trend. A downside break would have us dealing with yesterday's low, and then we would get tangled up right around in here. I don't see us getting any worse than that, and I don't see us getting any better than this without some serious catalyst in the market. We're only down 0.25%. And the S&P right now has an ADR of 1.43, so there's still plenty of room to run. All right, so we're looking at the NASDAQ, same situation, muted marketplace, sideways. If your trading style is some form of trend trade, then you're likely going to want to avoid markets that look like that. Right? So if you're losing more than you win, quit trying to trade in markets that look like that. We have an ADR in this market of 1.86, and we're barely down more than 0.25%, so plenty of room to run in either direction. If we were to make an upside break, we'll get through the high of the Globex, which is basically the high of yesterday's Globex, other than that little wick report. And beyond that, we'll use our fibs to the upside. If we did bring out a higher time frame, you can see there are things out here worth looking at. I would consider this to be a very significant level of resistance, right? You can call it anything you want, but you can obviously recognize how many times we've struggled at this level. It is significant. 450, 16,450. So you just want to mark that down and recognize that when we get there, there is very, very likely going to be at least one soft rejection at that point. That's a trade opportunity, if nothing else, right? That you can load the boat and take a dip on that to the downside for a little bit of a mean reversion play or a fade off. I would not look for a hard rejection that would continue to fall to the downside. Don't get greedy. Just kind of lock in a little bit of love and close it down and move on to the next trade. To the downside, we would look to resolve yesterday's low. And below that, we're headed to 6,100. It's possible that we could get hung up around the 150. I think if it got that bad and we were headed in that direction, that we would just punch right through it. There's a dip, a shallow area in the volume profile right there. We will move through this zone. If we happen to go down into this area, we will move through this point very, very fast. There's no volume nodes there. So if we break yesterday's low, it's game on. And at the very least, we would expect to get to 162. I don't think that we would stop there, though. And it'd be more likely that we would get to, the day before's intraday low, Tuesday's intraday low. Evergrande has been labeled default. They did miss one of their payments. They're not the only ones. There's a nice little article about it on Bloomberg, kind of trying to just fill people in a little bit and help them understand the ramifications of what's expected now out of this. It's a good read. It doesn't take very long. I think I read it before I had even signed in, so I don't think you need, to be subscribed to Bloomberg. Which, by the way, I use my college email address to get Bloomberg, and I end up with a Bloomberg subscription for like $1.25 a month. How could you pass that up? So, it doesn't have to be some expensive thing just to get Bloomberg. And they do offer a free 5 things you need to know in the morning. It's a nice little heads up because it usually focuses on what happened while you were sleeping. And they'll email that to you for free. You just go over and get it. We had some significant moves yesterday, and there was quite a few times where I didn't understand what the heck I was seeing. That used to really bother me because I would think that I'm really lost and that I have a long ways to go in my learning and in my understanding, because I would be looking at a market and I would just be completely confused. Yesterday, there were times where I was completely confused, but I don't feel bad about it because from what I read last night and I seen this morning, 30-year analysts right now are sitting there completely confused. And if they've been doing it for 30 years and they didn't get it yesterday, I don't feel so bad that I didn't get it yesterday. What did I not get? Well, yesterday there were times through the day where the VIX was going down and the dollar was going down and the bonds were going down and our indexes were going down. That doesn't make any sense, man. That it's not supposed to work that way, right? So then there were other times through the day where the dollar was popping and the bonds were falling and the markets were falling. So stocks and bonds both going down while the dollar was going up and the VIX wasn't moving at all. Again, not supposed to do that. It's not supposed to work that way. So, we lean on these tools and we use them to our advantage as much as we can because they are supposed to do certain things. But there's no guarantee that that's what they're going to do. And yesterday was a really great example of that. Stocks and bonds and dollar all moving in the same direction with the VIX. Really? So, I guess the takeaway from that is just be very careful right now about building up in your longer term portfolio or in your longer term swing trades. We definitely don't want to sit out of the market, but keep the positions small. Be ready to hedge those or just carry a hedge as a part of doing business. And like IBD says, the way that you size into your positions should be directionally proportional to the health of the current state of the market. So be cautious out there. Be ready to at least lock in some gains to protect yourself. With all of that craziness, it doesn't mean that we want to quit watching these tools, right? There are just times where the tools don't work. I want to recognize when those times are so that we're not getting misleading signals. Continue to watch these things for some perspective of where we're at. Hey, we got an update. So we want the S&P 500 because it doesn't offer an S&P 100. We'll just filter it by market cap. So we use the filter, try to nail this thing down to around 100 names, which right now, because of the market cap, about 115 is as good as I can get. I usually end up with either 115 or 80, and I'd rather have the 115. Give it a color adjustment, kind of brings things into perspective. It's not necessarily that we're in a risk-off environment, which is what it feels like with all of this red. It's more of the idea that we haven't really got anything, right? If you look at the positive first, one name, Pfizer, above 0.5%, other than CVS, which had news. So we got, everything else in the green below 0.5%. Quite a bit sideways. A lot of names in the red, but again, a lot of these names are below 0.5%. And the ones that are above it is finance, 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 finance. And some chip names thrown in there just for good measure. I want to flip this one over to the NASDAQ 100. Just change the watch list to go with it. Pre-market change percent. We don't need to apply a filter, just add a little bit of color. It feels very bearish, right? It feels negative. But looking at the market, listening to what's going on this morning, it's not necessarily that we're negative. There just isn't any exuberance. There's no inertia, right? There's no push on the backside of this. So we're like just drifting, waiting for these numbers. The drift happens to be slightly downward, but this is in no way a negative or bearish market. I wouldn't want you to hold that bias going into the open that we should in some way be looking to go short the market. Not yet. Get some news out of it first, right? In the NASDAQ, how many names are up at least 0.25%? 5 names, and 2 of them at least are China names. Not really inspiring. For the S&P 100, how many names are up at least 0.25%? 3, and 2 of them are health at least. Not looking that fancy, right? So when you're over here and you're looking at these names, it's not the individual name that you really want to focus on in the pre-market. It's what does that name represent? Who are its peers? And is there or could there be a trade opportunity this morning? Since most of these are in the red, we're not going to have a lot of red to green setups, right? That's where you're using the daily chart and you're looking at the daily candle and asking the question, is it going to be a red to green today? Was yesterday a red day? And is today going to be a green day? And if we happen to be starting that way, at what point are we going to open? Right? Are we opening close to the previous day's high or not? One of the names yesterday that had a red to green, although it wasn't a really good red to green, it still is one, was NIO. This is something that somebody had asked about yesterday. So I knew that it was already here. So yesterday, being Wednesday, we'll look at Tuesday's candle. We would look for a market to close in the lower portion of that candle. And in the pre-market yesterday, we would want to see that it had rallied up at least as high as the open of the previous day. Now you can see NIO had a great day yesterday, right? So it was still a red to green and it still worked out. It just wasn't what we would want to see. And I would argue that, the follow through wasn't as good because it wasn't as what we would normally want to see. If this thing had a really good red to green, it would have opened up at least as high as the previous day's open, and it would have been through the worst of all of the pivot points. Instead, it opened much lower. In the fade back, though, when it did start to fade back, at least it tagged the institutional pivot point, the close of the previous day, and then caught the rally up from there. It still couldn't get out of the wedge, though, right? So now we have this bear pennant that we're looking to fail and run this reciprocation back up. But these red to greens, we're not going to have as many of these opportunities today since we're going to be opening a lot of these names either flat or down. So there won't be that pre-market lift trying to get up to the yesterday's high. If you happen to find one, that would be one worth watching, right? A red to green at the open, especially if you can find a red to green with multiple inside days. Those will be a really nice trade setup. All right, so looking at the sectors, everything is red, just to varying degrees. And I know that this dark red writing on these dark charts is very hard to see. TrendSpider's coloring scheme here really leaves a lot to be desired. But this red isn't any better on that blue background. Either way, cloud computing, which is the ETF that we use to monitor those names, it's like big tech is one way to kind of think about it, is the one down the most, and then energy again, and finance. Tech is down also, just not as much, right? And it's going to be, with all this stuff going on in the dollar and the bonds, and I mentioned it yesterday, I'm watching finance for my opportunities. It doesn't mean it's the only thing, right? But there's a lot of great companies to trade in finance that are relatively cheap. You know, a lot of really good names, less than $100 to trade. Very liquid options, a lot of possibilities, a lot of opportunities. And connected with that is energy, since they've been so tightly correlated, and there are a lot of really great energy names to trade that are cheap. Cheap and liquid is like, we got to get the bumper sticker and the t-shirt. That's the best thing out there. So keep your eye on the financials. I like the fact that a lot of them are slightly red or slightly down this morning, because I'm looking, for the reversal play. If you look at Morgan Stanley, for an example, we had that micro cup and handle, and we had that breakout rally that all kind of faded back. You could consider this like a really, really big Busby. In shape, yeah, it's a Busby, but in theory and in trading, no, we wouldn't trade it as a Busby. But we had that resistance, finally broke out of it, and we're pulling back and testing that resistance. If we can get that fade through the morning and end up catching a ride on Morgan Stanley right around that $100 mark, we'd have a nice play, right? Back up to 103 and maybe crest out through that by the end of the next week. I'm looking for some swing trades in here, just not looking to go very big in those swing trades. Like I started this stream talking about, we want to start building slowly small positions because of the current market environment. If you look at the names on the list that have weekly options, since the sectors are down, we're not going to be able to play the sectors the way we normally would. You're going to have to be stock pickers today. You're going to have to use your scanners and go out and find things to trade. And trust me, there are a lot of things to trade today. These two watch lists right here show you that there are plenty of really great names with really good setups that are on the move. So there's plenty of things to trade. You're just not going to be able to lean on those sectors and in the indexes the way we normally would. That's what I got for you guys. Be careful and be safe. Have a good day, and I will see you all tomorrow.